Hello, my name is Jason Martin at AllGen Financial Advisors, and today we're going to talk about tax loss harvesting. So before we get into the details of tax loss harvesting, it's very important that you understand the lingo. Well, to kind of give you a basic definition of tax loss harvesting, that would be the selling of securities at a loss in order to offset a capital gains tax liability. So this is a way to potentially lower your taxes. Now, in order to understand tax loss harvesting, you need to also understand what are realized and unrealized capital gains. Well, let me give you an example about realized capital gains. So realized capital gains are for stocks that you've already sold. So a gain or loss is realized when it is sold. So let's say, for example, you bought Apple at 100, you sold it at 110, you just realized a $10 gain. Okay, you just take your what you sold it for, $110, subtract that by your cost basis, which was 100, 110 minus 100, that's a $10 realized gain when you sold it. Well, an unrealized gain or loss, but in this example, I'll use the same one. If you bought Apple, but you haven't sold it yet, and you still own Apple, and now it's trading at $110. You bought it at 100. It's now trading at 110. You still own it. You haven't sold it. So that is an unrealized gain. Okay. If Apple went down to 90, okay, and you originally bought it at 100, that would be an unrealized loss. You still have it. You haven't sold it. Okay. So that's unrealized. Now, there's also long-term and then there's short-term capital gains and losses. Long-term capital gains are when you've held the position for longer than a year. Okay, short-term capital gains are for gains or losses that you've held for less than a year. And so the reason that's important is because typically long-term capital gains taxes are lower tax rates, and short-term capital gains taxes are at higher tax rates. So for the simplicity of this video, I just want to kind of keep things simple, and we'll just assume long-term capital gains rates, and we'll also assume long-term capital gains rates are 15%, which for most people at the recording of this video, that's what they're at. So let's say, take an example here, you wake up, it's December, and you realize you have $100,000 in realized capital gains. And so that's great. You had $100,000 in gains, but so it's a good problem, but it's still a problem, right? Now, if you take 15% of that, that would be your tax liability for long-term capital gains. So that would be $15,000. $100,000 times 15%. That's what you'd have to pay the IRS, is $15,000. Now, if you were to go into your brokerage account and look at your unrealized capital gains and losses, and I just took a snapshot of a sample portfolio of some unrealized gains and losses. And to keep this video really simple, I just used 4 positions, all Vanguard ETFs, to keep it simple. And I also, but this portfolio, even though there's only 4 positions, is still diversified. Okay, so you have your large cap, your S&P 500 fund, you have your small cap fund, you have your bond fund, and you have an international stock fund. And so these are your unrealized gains and loss. Well, you can see the top 3 positions here all have gains. However, this international stock ETF has a loss of $20,000. Well, what if we sold that position in order to realize this $20,000 loss? Remember, right now it's unrealized, but once we sell it, we would realize that loss, and we can pair that loss up to this $100,000, which means we could take $100,000 minus the realized loss if we were to sell this position of $20,000, and you'd end up with $80,000 and again, we're still using long-term capital gains, and so $80,000 instead of $100,000 means you pay less in taxes. So that the potential tax savings with that would be basically $20,000 times the long-term capital gains rate of 15%. So you take 20,000 times 15%, that'd be a $3,000 savings. So saving yourself $3,000 to the IRS is great. However, if we just left it at that, that could be a problem. You sold a position that was down. So let's say, for example, we take that same position, the Vanguard Total International Stock Fund, and here it was just trending nicely, going up, and then all of a sudden it went down a lot. and then you sold it right here in order to take that 20% or that $20,000 loss. Well, what happens inevitably when something goes down, especially when an index goes down, usually it comes back up, right? So, if you were to sell right here and just have cash, you've missed out on all of this rebound here. Not only did it get back to its all-time high here, but it ended up getting much higher. And so by saving yourself $3,000 in taxes, you potentially missed out on 20 to maybe even 30, $40,000 in the position going higher. And so you wouldn't want to do that. So here's another example. So what if we sold, doing the same thing, we sold this Vanguard Total International Fund, and instead of just keeping that money in cash, right, we want to sell this 20,000 to take that and realize that loss. But instead of just selling and staying in cash, let's say we bought a Schwab International ETF, so a similar fund, but not the same exact one. You couldn't sell this fund and buy the exact same one, because that's what's called a wash sale, and that will be something to talk about on another video. But you have to buy a different fund. So let's look at this example. So this purple dot here represents, or the purple line represents, the Vanguard Total International Stock Fund. This is the one in that prior example that we sold down here. So if we sold that Vanguard fund right here, and simultaneously we bought the Schwab International, a very similar fund, at that same time frame, with the same dollar amount that of the sales proceeds, and that example is 80,000. So if we sold 80,000, then we turn around and bought 80,000 back into that same fund, back into the Schwab International Fund, a similar fund. Then when the market rebounded and when those international stocks rebounded, you rebounded along with it. So you were able to get the best of both worlds. You were able to take the loss by selling right here, but you don't miss out on the gain. And that's ideally what we're looking to do when we do tax loss harvesting. And so this is something that we do for our clients in our tax managed accounts. We do tax loss harvesting, and it's a little bit more complex than the example I'm giving here. However, similar principle. And so in summary, the two main objectives when doing proper tax loss harvesting is to capture the losses, right? In order to reduce taxes, we're trying to reduce taxes. However, it's more important to maintain a diversified portfolio and not miss out on the gain. So from the sale of that position. So explain these things, and we put out videos similar to this to help you guys stay educated on what we're doing with our clients' accounts. But at the same time, if you're watching this video and you're not a client, then we want to help you just kind of understand how to make really good financial decisions. So I hope this helps. If you have any questions, feel free to reach out to us, and please check back as we do videos like this all the time. Thanks. Bye now.